So a little background, I started BattleFin about 6 years ago. One of our first partners was RavenPack. We had done a data scientist competition in Miami called the Big Data Combine. We had sourced about 7,000 models. We used RavenPack, Dow Jones, iCentium, and a couple other data sets. And I think the evolution that's happened in the last 4 or 5 years has been amazing because it was so hard to not only find data back then, but clean it, scrub it, get it ready for production, build models off it. So I think we have a really interesting panel here today that can kind of speak to a lot of the different aspects of that. So we'll start off by having kind of Milind give us a little background, and we'll go down the row and get started.
Sure, thank you, Tim. So again, thanks to RavenPack as well. What a fantastic conference here. I've been in the industry 22 years, mostly on the buy side. Ran a bunch of money at Merrill with the rest of the company. Subsequently, ran prop desks at Deutsche Bank and RBC before launching QuantZ, and many of you know us as QuantZ, the hedge fund. We're also in the signal sort of data space now, working on a combination of factor investing and machine learning. We just launched one of our first signals, the LBO model. So with that, I'll pass it on to.
Hey, I'm Matei. I run a company called System 2. Before that, I started a data science team at a hedge fund called King Street. And I was just reminiscing backstage earlier that I came to the very first RavenPack event about like 7 years ago, and that was when I basically realized that there's a lot of potential that alternative data has to offer. And yeah, so in the past couple of years after I left the hedge fund, started my own firm, we've devoted our time to providing essentially outsourced data science services to investors who want to figure out how to make sense of all this data.
Rajesh?
I'm Rajesh. I'm responsible for leading the data science practice within the equities division of Merrill Lynch. We recently formed a data and innovation group. The idea was to bring a bunch of forward-looking leaders to reimagine the front office in a world that is data-driven and where our clientele is increasingly quant-focused. As part of this practice, so I'm involved in both in data management, in data engineering, and in data analytics. Data management as in democratizing data access and ensuring it's the right quality. Engineering as in worrying about SDLC in a world where you have to productionize machine learning models, having the right infrastructure that people can use. Analytics as in the right signals. It need not necessarily come from machine learning. It can come from other statistical analysis. Also acting like a point of, we run proof of concept projects around machine learning that we can demonstrate and spur innovation. We also offer an internal advisory around how to use the latest techniques in machine learning if they are applicable to solve a certain business problem.
Peter.
Yeah, my name is Peter Hafez. I'm the chief data scientist at RavenPack. I've been with the company for nearly 10 years and have as well been part of the alternative data industry for just as long. The team that I manage, we are responsible for coming up with research, inspiring people on how to take advantage of our data as part of various investment frameworks. We, of course, also work on more internal projects to RavenPack. We are very much involved in product development as well.
Great. And I guess we'll kick it off with Milind, because I think there's probably a lot of quants in the audience. And you've had an interesting evolution from quant to then starting to think about alternative data. And how does your day-to-day change? And when you're purely more quant or factor-driven, and now you start to think about adding some alternative data or big data sets, what does that transition look like? Or what do you have to do to start thinking about using data?
Absolutely. So if I could go back even further, many of us were trained as sort of derivatives pricing quants. That used to be trendy back in the 90s to do a lot of closed form solutions in math and try to, do the exotics and structured products. Obviously, that's less trendy these days. And I would argue that actually, the role of the buy side sort of analyst or manager has evolved quite a bit from those days to now, where it's not just the traditional factor stuff, but also a lot of the alt data signals. And hey, how can we incorporate, RavenPack or satellite images or footfall traffic and all these other ideas? Now, obviously, with limited bandwidth, there's only so many signals you can crunch, but we've tried to evolve with that, and we've always had a bunch of machine learning driven things in the mix. I mean, as a stat R market neutral fund, of course, you have to do your pattern recognition in the classic stat-arb context, but also in the, we've tried that with other cross-asset data like CDS or options or whatnot. And so we were always running those type of strategies. And over time, we started incorporating sentiment-type signals, which is the bailiwick of the RavenPacks of the world, and that was kind of the first big wave of alt data that came out, and so we kind of rode that, and we also try to incorporate a lot of these ideas into regime identification and things like that. So yeah, it's been a significant evolution from the good old days of value growth too.
Yeah. And Rajesh, you kind of have an interesting side as well. Like even if you looked at what you were doing at JP Morgan, now at Bank of America, Merrill Lynch, how does the day-to-day change? I mean, and what are the kind of things you're trying to solve for now with data versus kind of a couple of years ago?
And it really ties into what Milind said. It's the transition from being what I call a Q quant to a P quant. And Q was your risk-neutral martingale measure, your Ito calculus and Gilson theorem, that is much less valuable. And the P quant is your real-time objective measure. That's the probabilistic quant, right? And it's this shift from the old closed-form modeling world to a much more atheoretical statistical modeling. And it's taken some time, even for me, to get used to the fact that I don't have a rigorous model. I have my data, and I can model it, right? And it's just a variety of questions that get now asked. Is there a reason why it's being asked now and not before? It's actually interesting. It's like the water builds up behind a dam, and at one fine day it just breaks. It's not that water was not building up. There's no reason for these techniques not to have been used before. It's just that when you see a self-driving car, you suddenly wake up and say, oh, there's something there that we are not doing. And this transformation, what I see, is now touching every aspect of the role, right? If I look at sales, we want to understand how our clients are trading. Can we give them a better trade recommendation? In some sense, that's one part of being a sell-side provider is to enhance our clients' productivity by giving them better trade recommendations. That's important. If I'm a trader, are there certain signals that I can generate across different desks? Maybe my implied borrow rate in a risk reversal is useful for my borrow desk on another floor. Could be simple. Maybe my gamma imbalance is long. If I'm long, the hedging will cause a mean reversion towards the end. It's not really machine learning as such, but still very useful. And the examples that I gave in my talk, choosing when to do call overwriting or when to go long vol, short vol, all these signals are happening. If you look at the algo trading space, we can do very exotic stuff. It's 3 years back, people would have dismissed something like partially observed Markov decision process. Reinforcement learning would have been completely exotic. Do you want to do that today? It's more reasonable. Or you just want to predict your price ahead. That should have been done a long time. If you look at the execution algos, they're quite the same as they were 15 years back. Same TWAP, VWAP, implementation shortfall, market order at close, your liquidity seeking algos. They've not changed so much. So predicting prices, that is now coming. If you look at your sec lending and prime brokerage, do you want to predict when a stock will become hard to borrow? Can you predict the transition? So there are a multitude of very simple questions where we are collecting a lot more data and systematically trying to predict it. That is happening on a much more larger scale, much more systematic scale across different lines of business. That's the main change I see.
Gotcha. And Matei, you've been in the space a long time. Like, what's been the evolution, and like what's getting easier and what's getting harder?
I think one aspect that's getting a lot easier is just identifying new data sources, because for a number of reasons, there's conferences like this, Euro conference as well, that are bringing all these data sets to market. And that in the beginning was definitely where a lot of the alpha was. If you knew of a data set and you were talking to the provider and they're only selling it to 5 other funds, you were pretty sure that you still had alpha in there. But now that's definitely not the case, especially as more data providers think they can make money by going after the investing world. And so that's definitely become easier. Some of the changes and the challenges now are that there's been this assumption that big data is just so large that you can do some very simple computations on top of it, like counting things. Like, let's just count all the cars in the parking lot, and all of a sudden I can see what the foot traffic to a particular retailer is doing. But that couldn't be further from the truth. And what ends up happening is that there are tons of issues with all of these panels, regardless of their size. The size only makes it worse, but it doesn't take away from the fundamental challenges, which are how do you understand what kind of biases are in these panels? How do you know when the people keep churning into and out of the panels what that's causing? And there's this old saying that those who ignore statistics are doomed to reinvent it. And that's exactly what we're seeing now. Like, people have not been focusing on stats, and all of a sudden it's like, oh wait, I need to start thinking about these things in more statistical ways. And so, if you think about it in the context of the hype curve, we've definitely gone through that peak where there's a lot of like frothy data sets and algorithms, and we can argue that there's been some disillusionment with people not seeing the kind of alpha that they were expecting to see, not realizing the promises that the salespeople were making. And but now this is, at least in my mind, where the real work begins, and when you can actually start making some real changes is when you start working on these data sets. And it's not the terribly like sexy work, like, oh, finding out about new algorithms and implementing these algorithms, but it's just going back to the drawing board, figuring out what it is you're ultimately trying to measure, and then being more rigorous about that measurement.
Gotcha. And Peter, you guys are on the data side, and what's the evolution been in terms of, is it still you guys going out and looking for new data sources to run sentiment analysis on? Is it what's been the evolution that you guys have seen more from the data either collection or just kind of the sector standpoint?
We always trying to bring in more data sets, more, can you say, news content in order to get better coverage on a global scale or across various asset classes, but also moving beyond news and social media. So there's definitely a lot of interest around other textual content, where we can apply our NLP engine, for instance, analyst reports or earnings transcripts or regulatory filings and stuff like that. So there's definitely been a shift towards, I wouldn't call it exotic from that perspective, but beyond news and social media.
And then I guess following up on that, do different data sets, whether data categories, do they tend to work better with different time horizons? Like, if you were to say, sentiment and news, that might be shorter because the news comes out, and this is for any of the panelists, credit card data, is that great for calling quarters, but not great for longer term macro themes? Or how would you guys think about time horizons and data sets? Matei, or maybe Peter or Rajesh?
I mean, on my side, I think it has less to do with the data sets and more to do with what kind of questions you're asking of the data sets. So a lot of the work, even around credit card data, has been in calling the quarter, and which is sort of fine. Although ironic, because most fundamental investors will tell you that they're not interested in short-term trends, and then they'll be freaking out about the quarter. But the other part of this is, like, you can start, and I mean, it's so true, like this, yeah, it happens all the time. But the other part of it is, you can ask some deeper questions of these data sets. So for example, instead of just looking to understand the quarter, can we understand customer lifetime value and what it costs to acquire each one of those customers? So if I know that the top line revenues are fine, but then if I drill down into it and you notice that the most loyal cohort, the one that's been most profitable to me as a company, is churning out, and I'm replacing it with people that are much more fickle, even though your top line might be fine, you might be getting the quarter right, the long-term health of that company is not there. And so being able to use these data sets and predict things on longer time scales, I think, is definitely possible, but it's also a function of how the traditional fundamental analysts have been thinking about their coverage universe. Like, they haven't been taught, or they haven't had the data available to be asking those kinds of questions, because they didn't get purchase level information for each individual customer. The only thing they're accustomed to is seeing these quarterly reports that come out that aggregate all this information at a very high level. But now, if they're given these opportunities to essentially act as if they were working at the company directly and they had access to all these databases, what kind of questions can you start asking? Can you look at a company like Amazon and be like, well, maybe I don't want to model it as just like a pure revenue retailer, but model it more like a subscription company. And how do I think about the retention rate of Amazon Prime members versus non-Prime members? So you start asking all these questions, but at the end of the day, it doesn't really matter for the time being, because if the stock doesn't trade around those questions, you might be asking the right things long term, but it's just not how the stock's going to move.
Gotcha. Anyway, Peter, or do you?
I agree. You can't say just a particular data set works on a particular horizon. In general, I would say, but it very much depends on exactly what questions you ask. I would say if you look at something like sentiment, for instance, from RavenPack, if you take a simple signal and say I'm going to trade that as a standalone, it may decay fairly quickly, because that may also be one of the things that most people will think about doing first. But it starts to become more interesting as you start to build it into some sort of more sophisticated hypothesis that you have. Combining it with, I don't know, short interest information or overlaying it to some more traditional factors or something like that. And I think if you are to extend a lot of these alternative data sets into longer investment horizons, you need to have very targeted hypotheses. And I think later this afternoon, there's a very good example of that from Citigroup, where they think up some CapEx strategies, which is, can you say, using only a small subset of the RavenPack data set, but they find a way of kind of making it work on longer horizons.
Gotcha.
So I'll actually not offer a contrarian perspective, but I'll slightly augment it in a different direction. I do associate certain data with certain time frames, and I'll illustrate that with traditional data because it's better understood. If you look at longer horizons, you look at GDP, inflation, unemployment, you look at how much a central bank is holding, that gives you a longer term picture. If you come slightly shorter, you look at accounting parameters, you look at, and maybe relative to median, relative to sector, accounting matters tell you. If you go even shorter, maybe you can look at CFTC positioning data and other stuff. If you're looking at a matter of days, maybe you say, I'll ignore the initial flap of the butterfly, I'll track CTA and risk parity, maybe they'll tell me. If you go even shorter, I gave you the example of gamma imbalance, which is a very intraday signal that you can use. So even outside of alternative data and traditional data, at least in my mind, I tend to associate certain data with validity over a certain time frame. But yes, I agree that depending on the question you pose, you could use this data across different time frames.
Gotcha.
Just want to add to Peter's point. I think that's a great point. There's a lot to be said for combining alt data like the RavenPack signals with more traditional factors. So that's something we've been working on, that kind of research in terms of, how do you combine the traditional factors, which are typically much slower, lower turnover with much faster moving signals, like sentiment.
Gotcha. I guess if we go back to Rajesh for a second, it seems like there's a big, I don't know if you want to call it evolution or actually revolution on the sell side, because I think what you've seen in the past has been, and whether it's the fundamental world, that there was a process of analysts taking sell side banks taking companies public. The analysts would pick them up. They'd have tight relationships. They'd cover research on that side. And I even think like the current research budgets are $7 or $8 billion a year, so they're still doing it strong. MiFIDs happen. There have been some changes. When you look at the alternative data market, you kind of see maybe that's around 600 or 650 million a year, and it seems like there's definitely kind of a shift, and there's almost a haziness happening where, at least on the buy side, what's considered research, what's considered data. And kind of, how do you see the, kind of the sell side evolving? How are you guys thinking about it? Are you trying to put data in the hands of the analysts? Are you trying to create, is there a thought to create research-driven data products? And we'd just love to kind of hear where you see things going.
Definitely, and so it depends on the analyst in question. I agree with all the points that you said. Research has fundamentally changed. If our clients are looking at new data sources, they're not waiting for a weekly rig count. They're not waiting for a monthly CPI number. They're looking at a daily inflation series. We have to cater to that audience. If the aluminum market gets roiled and others are looking at satellite images saying nothing is happening, or they're looking at counting cars and answering it, our analysts have to use new data sets. Sell side has been behind the curve across all banks. It's not specific to one bank, and that needs to change. How will it change? It might change in terms of a standard API that's being given to a certain analyst. It can change in terms of an alert being generated for certain others, or it can change in terms of a report being given, and so which they can further interpret and do. This is something that, the way I see it, one of the two things that sell side does, apart from execution, is to enhance client productivity and offering them trade recommendation. If the market is moving on this newer information, new data sets that are in many cases predicting the traditional data sets, it leaves us with no choice but to move with the time. The other part of the story is the best execution one. The adoption of algo wheel reduces the value of the old relationship business. There is a shift across sell side in moving from thematic advisory to more trade-focused, monetizable transaction. going from long to long only, moving from qualitative and fundamental to quantitative and systematic. That is an ineluctable push that's happening across sales and trading and research, which will happen. So it's the exact contours are not yet fleshed out as far as I can see, but this move is happening in that direction.
Yeah, I think there's also another interesting aspect, which last week I was in Chicago and it was a Jefferies Investor Relations conference, and I think we spoke about this at dinner last night. And it was interesting, they probably had 200 investor relations people, and one of the topics we were talking to about was, it's going to fundamentally change. You used to get calls that would say, hey, Bank of America downgraded the stock, what's going on, to investors and shareholders calling and saying, hey, we see that your parking lots are empty at Lowe's, what's going on? And so I think it's not just going to touch, kind of the investment world, it'll touch, kind of the corporate world, and then even further to that, you're going to see, if you have a data set that can help predict sugar prices, and that's a big cost of goods sold for Coca-Cola, they're going to want that data set as well. So I think it's definitely going to go across the, from finance to the corporate world. I think one of the hard things, and especially with so many new data sets being created, is figuring out the quality of the data set. And maybe Peter, you guys will see different data sets. And Matei, like, how do you guys think about quickly assessing, what is the quality of this data set? And maybe that's kind of an interesting process from, okay, got the data, NDA, historical data comes in. How do people think about figuring out the quality of a data set?
I would say from our perspective as RavenPack rather than our clients towards RavenPack, well, when we take in new sources, we of course need to understand them very well. So we will test them in different ways. First of all, we need to understand, are they able to deliver a historical archive to us that we can work with? Mm-hmm. Are there issues with that archive? Are there holes in the archive? Can you trust the timestamps and so on?
And then, what do you do, like say you get something that doesn't jive up? Is that just kicked out immediately, or do you go back and kind of say, okay, explain this, fill it in, come back, and does that,
We will try and work with our vendors to get the quality necessary for us to be able to productize on it. And we will, as I mentioned, both, look at the historical archive itself, but also test the live feed if they're able to deliver. And that's kind of the starting point. Mm-hmm. And then it will go into, classification and so on internally within RavenPack. And then we will try to see how it adds value to the sources when you compare it to sources that we already consume, because there's no reason just to add new sources to add them. There's a cost to it. Mm-hmm. And we need to, of course, have an end product that people is also willing to pay the price for. So we are trying to only, add content when we feel that there's a value add to the overall product. But I would say from a pure evaluation point of view, we will look at counts and these type of things and patterns and making sure that there are not holes in the data, or how many entities do they cover. So we do some general statistics, and then we will try and run some basic type of predictions on the data to see how.
Do you know, what percentage of those data sets do you think, or the data sets that come in, are they already mapped to tickers or companies, or are you guys doing a lot of that on the kind of taxonomy side? And because I think there's a whole nother layer that gets into how complicated that is, and corporate actions, and how are you actually thinking about those and keeping this golden security key in the background? I know you guys have to do that because you're, with the news, it's, okay, you need to know that Colin Kaepernick is, Nike related, and now that could have a negative brand impact, and then tie those all together. So how do you guys think about that? And Matei, you can follow up as well.
Yeah, I think that definitely it's one of the big challenges when you look at unstructured content, right? Especially also when you look at archives of unstructured content. How do you match it or map it back into tradable securities? Mm-hmm. So we do a lot of work around entity detection. So we don't really detect securities, we detect entities, and those could be companies or places or organizations or currencies, commodities, and stuff like that. But in order to make it easier for clients to consume our data, we obviously also provide mapping files such that you can map it to QSIPs and ISINs and CDLs and Tigers and so on, whatever makes it easy for you. But it's often ignored when people say, let's try and, let's do our own, develop our own NLP capabilities, that all of these small nitty-gritty things of maintaining, can you say, your entity universe and how Gillette was Gillette up until they got acquired by Procter & Gamble, and then it becomes a brand name and all of these type of things. All of that work, we have a huge team that are also providing a lot of, can you say, human intervention in how to build these graphs and of entities and how they are related. So it's a huge task, and I would say it's definitely part of our value add of solving those problems for clients.
Gotcha.
Yeah. Just like echo some of the stuff that Peter was saying, I think you can have an entire conversation about the whole like data evaluation and data cleaning process. And again, it's not one of those like super sexy topics that people necessarily want to hear about, but it's how you spend the vast majority of your day. And so from our side, I mean, it's also just amplified by the fact that we're seeing tons of new data sources. I mean, I used to love talking to people, and now I hate it. It's like, oh, another one of these, another one of those, and it's trying to figure out how to filter through all of that noise. But the more you see it, the more you start picking up on patterns. So there are certain things that that we start asking for, in particular data sets, in order to understand how much, like how the data is being collected, what kind of information, what they've done on top of that raw data that either made it better or oftentimes made it worse, and how can we unfix the things that they were trying to be helpful with. And so for example, I mean, we're looking at even just, okay, so if you're getting, let's say, a mobile location data set that tracks people's movements, there are so many different assumptions that go into that if it's been pre-processed. So for example, if you're just getting visits to a particular retailer, like what constitutes a visit? How do you filter out people that just drove by? How do you take into account the horizontal accuracy of the devices that are going through? So understanding the building blocks, not just like the building blocks from a data set level, but also from the operating system in that case. Like what limitations does Android and iOS put in place that would provide essentially like these limits to what can be done with the data? And then one of the things that we do is once we have a bunch of these data sets is we run forecasts on them against some sort of ground truth, which is not necessarily always available. But you find something that's been reported that you were trying to measure, and then you just run all these data sets to see how they would have performed against this one metric. And even there's a lot of stuff that goes into it. It's like you might run it through all the models, but what analysts ultimately expect is one number. Like I just want to know if this quarter is going to be up or down and how much. But if you're bringing in data sets from, I don't know, like 5 different vendors, and you've done 10 different things on each one of them, and you've done, I don't know, another like 10 different ways of cleaning the data, you now have like all these combinations of possible forecasts for the quarter that you need to somehow evaluate. And this is another example that, again, people don't really think about, but even if you do something simple like a regression, how do you know that 2 regression lines are different? How do you like statistically compare regression lines? And this has applications even like when you're looking at a beta of a stock. Like how do you know that 2 betas, which are essentially like the regression of that stock versus the market, how do you know that two stocks betas are statistically different from each other? And these are questions that can be answered. It's not like super complex stats at all, but it's just something that you need to start asking yourself is, okay, like I ran all these models. How do I evaluate whether these models are actually producing different results or whether the results they're producing are within the same confidence intervals of each other? And so, yeah, like there's a ton of stuff that goes into it, and it's just scratching the surface.
I guess that kind of bleeds into the next question, which is, okay, you go out, you find the data set, you try to determine the quality of the data set. What's the next step? Taking us through that testing process. Is it correlations to other data sets? Is it correlations to stocks within that? And maybe Milind, like there's obviously a machine learning component that can come in here. Is that kind of the approach you're taking? And or there are other approaches that you guys have looked at that have kind of said, okay, there's a quant approach, there's a fundamental approach, which I mean, what we see is fundamental analysts and PMs don't think in the same way that quants do. And in a lot of ways, it's not, okay, a 1 to 10 day horizon. I need a 51% hit ratio to get that right, to get me interested, and then I'll do more work. It's kind of, if I'm a fundamental analyst, I'm covering telecom, I want to know if wireless ads are getting better I want to know if ARPU is going up, if churn's going down. Am I looking at local number portability data sets and then trying to go figure out which handsets are being lit up. But as we move to the testing side, is there a machine learning approach that you use or like? Is there anything that you guys have done? And Peter, I think we've read a lot of your research. Take us through kind of a testing approach. Like, okay, data set's clean. What are you looking for now?
I think it's always good to start out simple, just to see if there's can you say any immediate value or if the results that you can get is intuitive. So for instance, of course, with our data sets, a lot of our clients would take some of the research that we have done and try to replicate that research to see if they can get similar results as we can, and then they have a good starting point to kind of jump off and try to do something more sophisticated, something that may fit more within their model framework. But I think that's a good starting point, just to get a sense for the basic quality and kind of see if you think about the data in the right way. Otherwise, people will do something simple. Again, when we take in news providers, they will do something similar with our data, looking at various counts, looking at how much news volume is there across the universe that I trade over time. Does that change? They will look at the various indicators, for instance, that we have. What are the behavior of those over time? So are there some, are there seasonality patterns? Is it dropping off or in certain time periods and stuff like that? So just general, can you say, what do you call it, robustness check and see if it behaves in a similar way over time. And I think that's a good starting point, just starting out simple with some simple, statistical measures and some basic potential trading strategies, and then you can take more sophisticated approaches from that point onwards.
Gotcha. And one follow-up to that, and maybe it's Matei or Milind. There's been a lot of talk of combining data sets, and there's a couple different ways to think about that. But is it the ideal scenario? And let's use Home Depot again, where I'm using orbital insight, satellite data of that parking lot, maybe Cubic for their geolocation data going into the store, MasterCard to get an average, swipe or look at that with, RavenPack on the sentiment side to kind of say, okay, what's going on sentiment-wise? How do you guys think about combining data sets? Because there have to be a common key in the background that kind of stitches them all together so you can do that? Or, if you want to combine data sets, maybe kind of help the audience think about how you do that.
So with my manager hat on, I'd say, obviously you care most about risk-adjusted performance and kind of the marginal contribution of a new data set. I mean, is it improving my Sharpe ratio and overall drawdown performance stats, et cetera, et cetera? That's the most important consideration in the portfolio context. But the thing that we actually find also very important to look at before spending too much time on any given data set is it just raw? Is there an actual signal? Are we going to have to do the work to actually create a signal out of this data? And if so, fine. Maybe we're convinced that it's worth doing the work. But if they're giving us a so-called signal, did they make ridiculous assumptions? And that's actually, I think, where maybe there's a need for some industry standards to evolve in terms of how do data vendors present their stuff. I mean, can they make ludicrous claims like, okay, you traded this open to open and had 80% returns or something, and it turns out in reality that's completely impossible, and you would never want to do such a silly thing. So there's a lot of unrealistic assumptions, and I think it's partly because the data space is not regulated like the Reg D, SEC world. And so you can really spin your wheels sort of trying to assess the quality of those claims, and they can sometimes be very far-fetched.
Yeah. Anything, Matei, on the combination?
There's, I think, a couple of ways to do this. One is to just look at the data sets together but separately, in that you're trying to see whether they're indicating the same change in, let's say, revenue. And if you have 3 data sets that are all pointing to the same change, then you can be potentially more confident in that. And that's, I think, one of the easier ways of combining data sets. The other things you can do are, which I think are to get more interesting. So for example, like we have for various retailers, ways of counting the actual number of transactions, like all the transactions that are happening at the retailer. But we don't know the amounts of those transactions. And so maybe we'll use something like a credit card data set to get average basket size, and then for a given period, and then we can multiply that, what we know to be the ground truth of all the transactions that are happening there. So you have a data set where you have like super high confidence in its accuracy, but it's missing a certain component of it that's equally important, and then you layer another data set on top of that. And then another thing that we're doing that I think is also like super essential to getting the right answers are to understand the demographics of the panels that make up these different data sets. And this is difficult, and this is where you start having to deal with PII type issues. So if if I'm tracking a bunch of phones, or if I get credit card data from people, but I want to know, does this panel skew male, does it skew female, what are the incomes, what are the ages, how can we get access to that kind of information? And more we started actually relying on platforms like Facebook that have been built with this sort of like advertising intent in place, and they make it relatively easy to interact with certain individuals. And so we will start literally like surveying and pinging people that make up our panels to try to understand more about them, in a way to then use that information to normalize the panel. And then by the time we give it back to our clients, we've scrubbed all that PII out of it, but the result is something that's much more meaningful. So it's basically a way of combining something more old school like survey data with something like some of these newer alternative data sets.
Gotcha. And we did want to open it up to questions. So if there were questions, whether it was through the app or Susan, did you have anything?
Yeah, so we've got a question that's come through already through Slido. How do you know if you're paying a fair price for data? And how do you find brand new sources of data that aren't marketed heavily?
Okay. Does anyone want to take a crack at the pricing side?
I mean, on the pricing side, I've been on both sides of this, like buying data sets and then also selling it. Now that I'm selling it, I have a newfound appreciation for how hard selling stuff is. And the reality, quite frankly, especially in a new market like this, where there just aren't that many other competitors you can point to that are doing the same thing as you, the reality is you're just making up prices.
Yeah.
And you're just hoping that people pay them. That's not...
Well, it's also, I think it's interesting, like when you hear, well, you're interested in buying the data set. Well, what's your AUM? And it's
Yeah.
well, it shouldn't matter what my AUM. You're delivering the same thing to me that you'll be the same person to the same person, or And we actually thought about doing a kind of a anonymized survey to the data world, and trying to even do it a little bit by category. So geolocation. Is it really going back to how long is the data set? How big is it? How many people do you have in your panel? And obviously, if people don't know a panel, it's kind of the number of subscribers. If you're talking geolocation, how many SDKs or how many people are actually using that phone and that app. So the larger the panel, you usually think the better. But yeah, we see it just even from the event side, because we do data questionnaires and pricing questionnaires and all this stuff. There's a lot of ambiguity. But I think that would be something that will get improved as there's more uptake. Do you have any?
Yeah, I think there is some structure one can put in this problem, because it prima facie sounds pretty arbitrary. Well, you could pull any number out of the hat, but so I think the IBC analog is thinking about it in terms of if it's not raw data but a real signal. If I'm selling you a signal as opposed to you're allocating to a manager, right? And if you can demonstrate that, let's say hypothetically my signal gives you, so we've got this LBO model that predicts LBOs. If we could demonstrate that it hypothetically gives you 20%, right? I mean, we claim whatever we claim, and you're convinced. Now, if you had a manager doing 20% at 2 and 20, what's that? That's 600 beeps. Right? Yeah. But let's say we were to say hypothetically, okay, we're going to target 10, 20 beeps, whatever the number is. Mm-hmm. The claim is then now you're starting to put some structure in the problem. So yeah, maybe that's 30, 60 times cheaper. Okay, that's one way to think about it. So the AUM, I think, is a critical component, because there's always the trade-off between the alpha that's out there and how many people you're willing to sell it to, or whom you're actually selling it to, because, I mean, God forbid you sell it to BlackRock and then, boom, your signal dries up in one sell. So, of course, I think one has to price in the AUM context, but also, one should factor in the sort of benefits to the manager, because they can potentially expense the signal as opposed to hiring headcount.
Yeah. And then I guess on the sourcing side of the data, just one thing that Commoditization, I think you just alluded to. One thing we're doing is we're expanding internationally, so doing Hong Kong, doing London, looking for other areas to find data sets. On the commoditization side, and this was one of my questions that I was going to ask you guys, is like there's so many numbers that get thrown out there for number of data sets. So you'll hear, some people say there's 1,500 data sets out there. Before I answer, because I see a lot of it, like if you guys had to guess number of data sets that are out there, and I'd actually say usable, and by usable I'd define more than a year plus of history, because just because someone started a geolocation tracking side of things, like if you have 3 months, that's not going to tell you much. But do you guys have thoughts on number of data sets available? You have to answer.
Anyone? I mean, the way I look at it is that, and I definitely hear you that there's if you're going to put constraints in terms of the history and so forth, the number becomes smaller. But the way I look at it is that any company that's been in business for more than 5, 10 years, and it's been collecting data as a potential data source. And depending on, and the way that we approach these things, that we start with the problem we're trying to solve as opposed to trying to find out everything that's available. And oftentimes you'll just end up discovering a bunch of players in a random industry that you're interested in. You talk to them, it's like, oh yeah, I have a database and I'm willing to sell some of that information. And part of it too is just like when you're having conversations with people at random parties, random events, like I love just figuring out what people do. And so for example, like this summer I was talking to some guy who was a mechanic on tractors, like farm equipment. And it's like, not like I don't have a ton in common with that guy, but we end up talking for like about an hour about his business and how much like data they're collecting off these tractors, how they have like GPS devices embedded in them, how they can like drive themselves. And now all of a sudden it's like, oh wow, if I'm actually interested in figuring out how much production is happening in agriculture, like those kinds of companies, like the repair shops for those kinds of equipment can give me a great indication of how much equipment is being sold, how much they're using it, and so forth. So like you never know where you're gonna end up finding an interesting data set for a project.
I think this when you think about sourcing data, I think you have to ask yourself also some important questions, saying, how much time should I try to spend on digging out this unique data set that no one else has had out of the potentially thousands of available data sets out there? Because at the end of the day, if you look at how many data sets at the end of the day are valuable, the conversion rates often are very, very low. We're talking perhaps 3% or 5%. So you have to spend a lot of resources trying to, first of all, find the data sets and then test them as you have lined them up on your list. And then, of course, you have to put that in perspective of saying perhaps it's better, even though it's a data set that is used out there by others, but at least I have validation, so I know that there is value. Perhaps it's better to invest your resources on somewhat proven data sets and say, now I want to become an expert in that. Because a lot of these data sets are rich and can be used in many different ways. And it's about the ones that are also willing to invest and go deep enough, because often when you see in investment firms buying new data sets, they will test it, they will find some value, and there is pressure on trying to get, the research and the signals into production as quickly as possible so they can show management that we are making money, we're making more money than what we're paying and for it, and that's of course great. And they may have a multiplier saying we need to make 5 times more, 10 times more than what we're paying. But then often you kind of move on and say, now I need the next data set. So even though you may be consuming a particular data set and you may have, and you may consume a lot of data sets, it doesn't necessarily mean that you're an expert on every single data set. So that's a different strategy that I think is worth considering and saying, let's go for the proven ones, but become experts at them.
Mm-hmm. We can move to a question in the back.
So we've touched upon the different types of ML models to use when analyzing the different data sets, but how much time do you spend on the feature engineering part of a single data set, or how many features do you create off of one data set, whether it be dummy variables or time period changes, and creating, I know it's a bit of a loaded question, but do you find it sort of statistically relevant to have an array of different types of features off of one data set?
Peter, do you want to take that? Maybe. Anyone else that wants to jump in?
I think, of course, some data sets are more narrow than other data sets. And some data sets you are able to get a lot of different, extract a lot of different features from. And I think it is important to think about, how can I approach a given data set? What's most important, I don't know. I think it at the end of the day, it depends on your use case. But spending some time thinking about what kind of features you can construct, I think, is important.
Yeah, just to jump in on that, I mean, you don't want to over-engineer the problem. Obviously, the more features you're going to test, the more likely you're going to end up with some spurious correlations in some of those features. And so it depends on what you're trying to go after, right? Are you trying to do your hardest to make a certain data set fit a problem, and then you're just going to go nuts on it and come up with tons of interrelations between all the different features, and all of a sudden you found this most amazing thing that's got 40 different features all combined in various nonlinear ways. But that's not necessarily A, explainable and understandable, and B, you're just fishing at that point. And so you have to draw the line somewhere where you spend enough time on a certain data set and nothing's immediately obvious, move on to something else. I wouldn't try to fit a certain data set into an existing problem.
Anything, Rajesh, or move to the next one?
I'll reiterate what he said. If you're looking at a single data set, I would not overcomplicate. It's not worth it. And you asked the question of data sets that exist. I enumerated around 500 last year when I wrote the report. We looked in detail around 100. So even that most useful was around 30. Each of them, when we were evaluating a new data set, the question was how long do we spend at any data set? The answer really varies. We always needed some domain expertise. You referred to the panel, right? You always need to take a stable cohort. And so if you're looking at credit card data, it may have geographical bias. If you're looking at satellite data, you should not look at Europe, which has a multi-story car park. Those things, you'll make a mistake. If you don't know that, you'll probably need more time to analyze that data set. If you know all that domain expertise, then just look at level change, z-score, and quickly go, move on. And it actually ties to another question that I saw there, and it's been now removed. I said, is there a tool or a standardized approach? I don't see that question anymore. But
let's move to the top one if we can.
Okay.
Let's work through that. Sure. How often do you come across pre-processed data sets that you eventually find are filled with look-ahead biases? And that might be more Matei or Milind. Any thought on that?
I mean, it depends on who. If they're trying to sell you a signal, then I would be much more careful because they clearly have thought about how this thing correlates to the stock market. But more often than not, we end up with people that come from outside of finance and they don't even understand what look ahead means. And as long as you have faith in their dates and make sure that the dates represent what they're supposed to represent, then you can figure out that the data is okay. And so I'll always look at the incentives that people have. Are they trying to sell you on something that's predicting the stock market, or are they just giving you something that they've been collecting over time? And sure, there are definitely a lot of issues where they'll make some adjustment to the code, or they'll fix some of the numbers. And in fact, the as of date is not really an as of date. It's a data point that has been refreshed later on, which is bad. But if you can get down to some of those kinds of questions, you can often understand if they're trying to purposely or not purposely mislead you.
Gotcha.
Yep.
And then we'll keep going with some questions. How long does it take you to test the value of a new data set? I guess, and from Peter, from your standpoint, if it's a new signal that's coming in that you may be adding, is that a week, a month? I mean, obviously, I think there's more to that. How big is the data set that's coming in, or take us through kind of the process you might.
I mean, it can take quite some time because first of all, you need to, of course, bring in, and we might bring in a small sample at first, just to get a sense for whether that's even possible to deliver. We need to normalize the content into what we would call a RavenPack format, and then run it through classification and so on. So it could take quite some time, and it's correct, as you say, the size of the data set obviously also matters. So, but we will try and do a quick run first, perhaps for a limited time period. Of course, there's also cost associated with it. So we will try and get as much sense of the data as we can with as small a sample as we can, and then eventually we will take the full data set and classify. And that, of course, both take time to run. We have become much more efficient than we were 10 years ago. We are taking advantage of AWS, so we can very much run it in parallel so we can get our analytics back very, very quickly. But it can easily still take a couple of months or a few months at least to decide on whether we will bring in another significant source or not.
Yeah, and I guess it also could depend on the firm. Like, I mean, if you're like World Quant that has a process with the sourcing teams with those, that's much shorter to a fundamental firm that might be looking to get into the space. But I don't know, Matei, did you want to talk on that, or you're good?
I mean, I think that just even looking at RavenPack, you guys have been in business for 15 years and you're still like refining your process, right? So you're never quite done with any one data set. You're always finding new things and new ways of using it. And another point about it, just in terms of value, and we kind of addressed this a little bit on the pricing conversation, I think it's important to keep in mind that a lot of the work that we're doing is very experimental. It's in the realm of startups and not in the realm of these are things that have been tried and tested for a long time and I know what the return on investment is going to be. It's more like, well, this data set kind of seems interesting. It seems like it's got a lot of promise, but I don't really know how to extract the value from it yet. And you end up spending a bunch of time, you spend resources on it to try to figure out what the potential is. And then the next like sort of logical question there is like, how do you make sure you're not wasting a ton of money? And that comes into the differences between risk managing, so like a VC investment versus risk managing an actual like established company. And thinking about how to start small, how to iterate, how to develop like lean processes that you can pull the plug when things aren't working, but also be able to like double down on the things that are working.
But just to kind of address the question also in how long it takes, we could of course look across our clients and what we typically see in the marketplace. And typically we'll see that people have a good view of whether they want to go ahead buying a data set or not within a 2-month period, 60-day kind of period. And we try to structure our sales process also around that, allowing people to do these type of things.
Gotcha. Is there an issue with investors not digging deeply enough into a data set to find all the possible ways to use it? Kind of open it up, but it seems like one of the things I think that's come out of this is, different people are going to look at different data sets. So quants will look at it much different than fundamental, and I think, but Milind, how would you kind of assess that?
So I think you make a great point. I mean, this sort of bifurcation between the quant world and the fundamental folks, I mean, because, I actually think the overarching theme that we really didn't talk much about is this quantamental convergence play, the hybrid move, the fact that, given the kind of margin pressure the industry is in, and the only sort of legitimate edge now is data, right? That's the final frontier. I think the fundamental guys are really confronted by that issue of how to sort of marry that into their process. And I think there's a lot to be said for helping them along the learning curve because, the quant guys already have some process, a structure. There's a certain way they look at it. And whether it takes them a month or two, they know what sort of criteria metrics they're going to assess the data sets by. On the fundamental side, I think there's still, there's a lot of low-hanging fruit because there's still a lot of the investment world and the buy side is still doing very discretionary, stock picking. And the truth is that just simple factor investing type stuff can dramatically short circuit that zigzag of discovery. And, there's no reason people should still be, manually looking at any of the hundreds of factors that traditional portfolio managers tend to look at. Mm-hmm. So we think that's one part of the puzzle is just automating all the basic stuff so that one can then get to the more interesting questions of, alt data sets and footfall traffic and satellite pictures and whatnot, but also the moment you start combining the simpler stuff like factors, which we've been working on with machine learning, for instance, saying, hey, if I ran a bunch of random forests in these factors and look at how much more interesting the results are, well, then you immediately run into the communication issue of, well, the numbers are promising and in some cases really staggering, and you would think that people should really be jumping at them, but try convincing discretionary folks. About the merits of machine learning enhanced factors or whatever, which you think that, okay, at one level it's very intuitive, it's still growth value something, but there's a little black boxy, less transparent element to that. So.
Gotcha. We're running out of time, so I thought just if we go down kind of the line, cool new data set that you've come across or seen recently Peter, anything that's popped up recently, or even a sector that you see a lot of potential in?
I would say we of course focus more on textual content and trying to address, can you say, the problems that our clients raise to us that they would like us to solve. And we can definitely see that there's a lot of interesting data sets. Like when you look at internal content from people, internal investment notes that people have and they want to democratize internally within the organization, or even when it comes to email correspondence with clients and so on as well, and trying to make that more searchable across the organization as well. So trying to normalize all the textual documents that basically sit within an organization and make it searchable in a relevant way for financial firms. Okay. I think that's probably one of the more interesting areas that we see an increased interest in.
Anyone else before we wrap up?
I mean, on our side, we've been doing a bit of work on election forecasting with the midterms coming up and what the potential implications on FX rates are if the trade deals don't end up going through. So that's, there's things that are very cyclical that various times come back into vogue.
Okay. I'm going to throw mine out with, I think, visual analytics and kind of the IoT stuff, just because I think that the amount of cameras that you're seeing pop up everywhere, and then finding those companies that can look at toll roads or look at kind of production going into, or whether it's railway cars or different things. But anyone else before we wrap up? Well, thanks to RavenPack, thanks to the panelists, and we'll be around if you have any questions.
This is RavenPack.